Imagine, imagine telling a Wall Street analyst back in, say, 2020 that a legacy automaker would miss its quarterly revenue targets, navigate this massive industry-wide slump in sales, and yet somehow still swing to a staggering $1.4 billion in positive free cash flow.
Well, they would have laughed you right out of the room.
Right, like literally laughed you out. The math it simply wouldn't compute for a traditional car manufacturer.
No, not at all.
But looking at the stack of financial research, the analyst notes, and the Q1 2026 earnings reports we have on the desk today, well, that impossible scenario is exactly what Tesla just pulled off.
It really is a remarkable set of data. I mean, for years, right, the market debated whether we were looking at a car company or a tech company.
The endless debate.
Exactly. But the first quarter of 2026, which we're in now, this is the moment where the actual balance sheet data finally ends that debate completely.
Yeah.
We are looking at a fundamental rewiring of where their money actually comes from.
And that really is our mission for this deep dive today. For you listening, we are going to unpack this transition. We're looking at how a company that's, primarily known for stamping out metal boxes on four wheels is rapidly mutating into this high-margin AI, energy, and software powerhouse.
A total mutation.
And more importantly, we need to figure out if the underlying mechanics of this transition actually justify their massive valuation right now.
Cool.
So let's start with this Q1 2026 reality check, because
some numbers are weird.
They really are. The headline numbers tell a very strange story. If you just look at the top-line revenue, it came in at roughly $22.4 billion.
Right.
Which is actually a slight miss compared to what consensus expectations are looking for.
Yeah, but I'd argue that the top-line revenue miss is kind of a distraction.
Really? How so?
Well, the metric that reveals the actual health of this transition is the adjusted earnings per share, and that actually beat estimates.
Okay, where are the numbers on that?
They came in at 41 cents per share versus the 37 cents that was expected.
Oh, wow. Okay.
Yeah, so what you're seeing there is a dramatic shift in the quality of the revenue, not just the raw quantity of it. Selling fewer cars doesn't hurt nearly as much if the other things you're selling bring in vastly more profit per dollar.
Quality over quantity. And that brings us to, honestly, the most surprising piece of data in a stack today, which is the energy division.
Oh, it's wild.
It's completely wild. According to the research, this segment just grew by 90% year over year.
Almost doubled.
To see a physical division of a company nearly double its footprint in 12 months it's just rare. But the sources also highlight that the energy division is now actually surpassing automotive gross margins.
Yeah, which is the crazy part.
Could we explain the mechanics of that? Because on the surface, a massive grid-level battery, their megapack, it's still just a giant metal box full of mined lithium.
Why, yeah.
Why is the margin profile so much better than building a car?
Because a car is it's a one-time consumer purchase, right? And it's wrapped in this immense logistical overhead. You have complex global supply chains, you have consumer financing, showrooms, service centers.
All the legacy baggage.
Exactly. But when they deploy a grid-level megapack, they aren't just selling the physical battery. They are selling the proprietary software, it's called AutoBidder, that manages the energy flow.
Okay, so software is the secret sauce here.
Always. This software autonomously buys electricity from the grid when prices are low, right? And then it sells it back when prices spike.
So basically day trading electricity for the utility company.
That's a perfect way to put it, yeah. So they secure this high-ticket infrastructure sale up front, and then they attach recurring, extremely high-margin software revenue to it for the entire lifespan of that battery.
Wow. And it isn't just the energy sector experiencing that software-driven margin boost either. The documents we're looking at note that full self-driving, or FSD, subscriptions accelerated by 51% year over year.
Massive jump.
And if you're listening and wondering why Wall Street just absolutely drools over software subscriptions, it comes down to this concept called zero marginal cost.
Yes, the holy grail of tech.
Right. If a traditional automaker wants to sell 1 million cars, they have to buy the steel, the glass, the rubber, 1 million individual times.
Physical limits.
Exactly. But once a company writes the code for autonomous driving, selling the millionth software subscription costs them virtually nothing. Every single dollar from that subscription drops straight to the bottom profit line.
Which perfectly explains the cash flow anomaly you brought up earlier. We have these two explosive growth vectors, energy at 90% and FSD at 51%, and they're scaling up precisely when the traditional auto side was slumping through a notoriously sluggish 2025.
But I got to push back on the math here just a little bit.
Okay, go for it.
We know 2025 was terrible for overall auto sales across the board. We know Q1 2026 had that slight revenue miss we talked about.
Yeah.
Even with zero marginal cost on the software side, swinging to a positive $1.4 billion in free cash flow seems extreme.
It's a huge swing.
For our listeners, free cash flow is basically the money left over after a company pays for all its operating expenses and, keeps its factories running. It's the true measure of actual profitability.
Hmm.
So my question is the energy division just single-handedly bailing out the car division right now?
I wouldn't use the phrase bailing out.
No.
No, because that implies the auto division is structurally failing, and it's not. What the balance sheet actually shows is a reviving auto sector functioning as a massive distribution network for the software.
Oh.
We really can't ignore the April 2026 auto data.
Oh.
While 2025 was incredibly tough, April saw a record rebound.
I saw those numbers in the notes.
Yeah, shipments in China were up 36% year over year. In Europe, registrations in France were up 112%, and Sweden was up 111%.
Oh, wow. So the hardware side is actively recovering while the software side is exploding?
Precisely. You combine aggressive cost-cutting in vehicle manufacturing with a massive, growing influx of subscription cash from all those new drivers. That intersection, that's how you generate a $1.4 billion positive swing in free cash flow, completely defying the market's expectation that they would just be burning through cash.
And that cash generation leads us directly into what the sources describe as their fortress balance sheet.
Oh, it's definitely a fortress.
They are currently sitting on $35.5 billion in pure net cash. I really want to frame that for the listener because, context is literally everything in finance.
Oh, absolutely.
Legacy automakers are currently carrying staggering amounts of debt just to fund the R&D required to transition their old legacy factories to electric vehicles. In that environment, having $35 billion in pure liquidity isn't just a safety net, it's an offensive weapon.
It is the ultimate strategic advantage, especially in a high-interest rate environment like we're in now. And what they are choosing to do with that capital, that's what separates them from almost every other mature tech company out there.
Right, because usually when a mature tech firm builds up a $35 billion war chest, they just execute stock buybacks.
Exactly. They buy their own shares to artificially reduce the supply, which drives the stock price up and makes the shareholders happy in the short term. But Tesla is refusing to do that.
Instead, they're doubling down on infrastructure.
Oh?
The sources note they actually raised their 2026 capital expenditure, their CapEx, to over $25 billion.
Up from a previous target of $20 billion, yeah.
Right. And CapEx is simply the money a company spends to buy, maintain, or improve its physical assets, like buildings or equipment. So they are pouring this $25 billion into AI infrastructure, building out the physical cybercabs, and funding this really speculative semiconductor foundry known as TerraFab.
This aggressive CapEx spend really highlights a critical competitive moat in the autonomous vehicle space. I mean, just consider the landscape of their competitors for a second. Companies like Waymo or Uber, they are essentially software platforms. They write the autonomous code, but they have to outsource the actual production of their robotaxis to traditional auto manufacturers.
They have to buy the cars from someone else.
Exactly, which limits their margins and their speed. Tesla is using that $25 billion to handle mass-scale Cybercab production internally. They control the atoms and the bytes.
Let's talk about TerraFab for a minute, because this is where the strategy shifts from just building cars to trying to build the entire global supply chain.
This is the big pivot, yeah.
This foundry is reportedly tied to partnerships with Intel and SpaceX. The goal is to secure their own internal supply of semiconductors. Let me try an analogy here and see if this tracks.
Let's hear it.
In the early days of Amazon, they had to build massive data centers just to keep their own retail website from crashing during the holidays,
Oh,
right?
right. The origin of AWS.
Exactly. That internal back-end infrastructure eventually became Amazon Web Services, which is now the most profitable part of their entire business.
Is TerraFab the equivalent for Tesla? Are they building a massive back-end infrastructure play that eventually drives the entire company?
I think it's a really strong parallel. By bringing semiconductor fabrication in-house, or at least tightly controlling it via joint ventures, they are structurally insulating themselves from the kind of global chip shortages that literally crippled the entire automotive industry a few years ago.
Yeah, we all remember those supply chain nightmares.
Oh, it was awful. But it goes deeper than just cars. The compute power required to train AI models for autonomous driving and for their humanoid robotics program is practically infinite. If they're dependent on external chip makers, their growth is bottlenecked by someone else's production schedule.
They'd be at the mercy of the market.
Exactly. Securing the foundational layer of their hardware changes the margin profile of the entire company over the next decade. It is a massive structural play. But let's bring this down from the high-level supply chain mechanics and talk about a real-world product currently disrupting the market today: the Tesla Semi.
The Semi is fascinating.
It really is. The research notes that the 500-mile range version of the Semi is hitting the market with a price tag of $290,000. And according to the industry comparisons in our notes, this is drastically undercutting every other Class 8 battery electric vehicle competitor out there.
The pricing power is just phenomenal, and it ties directly back to that vertical integration we were just talking about.
How so?
Well, they can offer a Class 8 truck at $290,000 because they aren't buying the battery cells from a third-party supplier at a huge markup. They are supplying their own proprietary 4680 battery cells.
Right, cutting out the middleman entirely.
Exactly. But the technology is only half the story here. The real catalyst driving the adoption of the Semi is the current macroeconomic environment.
Right, because if you are listening to this and wondering why on earth you should care about the sticker price of a commercial semi-truck, the answer is that the cost of moving freight is baked into the price of literally everything you buy.
Everything. Your groceries, your clothes, everything.
If logistics companies can drastically slash their transport costs using electric fleets, it fundamentally alters the macroeconomics of consumer goods. And right now, the primary pain point for the logistics sector is fuel.
Fuel is killing them. The metric that dictates survival in commercial logistics is TCO, or total cost of ownership. And right now, national diesel prices have surged to $5.35 a gallon.
Ouch.
And if you are operating a fleet out of the massive ports in California, you are paying upwards of $7.50 a gallon.
That's insane.
It is. When fuel costs skyrocket like that, the payback period for a $290,000 electric semi shrinks to just a few years. The operational savings month over month make it almost financially irresponsible for logistics companies not to transition. The companies still burning diesel simply won't be able to compete on shipping rates.
I completely agree that the math for fleet buyers makes total sense, particularly with those California diesel prices. But we have to look at the physical friction here.
Okay, the roadblocks.
Right. At $290,000, sure, you can buy the truck. But can Tesla realistically scale the megacharger network fast enough across the country to make this practical for actual long-haul freight? These aren't your standard passenger car chargers, right?
No, not at all.
The megachargers required to juice up a massive Class 8 truck need serious industrial grid connections to push out megawatts of power. Can they physically build that infrastructure fast enough?
That is the multi-billion-dollar hurdle right there. And honestly, it is precisely why they allocated that massive $25 billion CapEx budget. They have the capital to build the stations, but you are identifying the exact correct bottleneck: local grid permitting, zoning laws, and physical construction timelines.
You can't just throw money at a city council to make them approve a permit faster.
Exactly. Money alone cannot instantly bypass a local municipality's timeline for upgrading a power substation. So their strategy is to prioritize high-density, short-haul freight corridors first.
Like what?
Like routes between major ports and inland distribution centers, where the trucks go back and forth on a predictable loop before attempting to conquer true cross-country long-haul routes.
Makes sense. Start where the density is highest. Which brings us to how Wall Street is digesting all this physical and financial expansion. Let's look at the technical breakouts in the stock as of early May 2026.
The charts have been interesting.
Very. The sources note the stock recently surged past the $400 psychological barrier. It hit 415.83 intraday and closed at 398.73 on May 6th.
To put that price action into perspective, that represents an 8.4% rebound over just 30 days, and more importantly, the volume of trading during that surge was incredibly high.
Let's clarify what that means for the listener. Sometimes the stock jumps rapidly because of a short covering spike. That's when investors who bet against the stock are forced to buy shares to cover their losing bets, which creates this artificial, temporary price jump. But the sources suggest this recent volume indicates something entirely different.
Yeah. The heavy trading volume over a sustained period signals what we call institutional accumulation.
Okay, so the big players.
Exactly. Major mutual funds, pension funds, large asset managers, they are actively building massive long-term positions. Big money is looking at the 90% growth in energy, the 51% growth in software, and the internal chip production, and they're deciding this is a strategic renaissance they need to own a piece of.
And the sentiment surrounding this accumulation is fiercely bullish. Our sources specifically point to a narrative fair value target from a firm called Black Goat, putting the stock at $588.18.
Just huge.
It represents an upside of over 33% from where it's currently sitting. But let me challenge that figure for a second.
Go ahead.
We hear these massive price targets thrown around in the financial media all the time. Is a $588 valuation actually grounded in the math of these new software margins, or is this just retail FOMO, fear of missing out, driven by day traders gambling on the word robotaxi?
It's actually heavily reliant on the math of a multiple expansion.
What does that mean?
Well, when major institutional funds look at a company executing a successful pivot into high-margin software and energy, they stop valuing it like a traditional automaker. A traditional car company might be valued at roughly 10 times its yearly earnings, but a software company with zero marginal costs, that might be valued at 30 or 40 times its earnings.
Oh, I see.
So the $588 target is the result of applying a tech software valuation multiple to the projected future earnings of the robotaxi and megapack divisions.
Which walks us right up to the edge of the cliff, frankly.
Yeah, it does.
Because applying a software multiple to a company that still physically manufactures vehicles comes with extreme, almost impossible expectations. This is the bear case we need to discuss, because a stock price this high leaves absolutely zero room for execution errors.
None whatsoever.
The research highlights that the company is trading at a price-to-sales ratio, or PS ratio, of 15x.
And that is the metric that should give any investor serious pause. For our listeners who don't spend their days staring at financial ratios, the price-to-sales ratio simply measures how much investors are willing to pay for every single dollar the company brings in.
Right. And what's the industry average?
The U.S. auto industry average price-to-sales ratio is 0.9x.
Wow. So investors won't even pay a full dollar for $1 of a legacy automaker sales.
Yeah.
But they are willing to pay $15 for every $1 of Tesla's sales.
Exactly. Trading at 15 times sales is astronomical. It means the market is entirely pricing in perfection. Investors at this level aren't paying for the company's performance today. They are paying a massive premium for a flawless, hyper-profitable future.
And the reality of their recent timeline has been anything but flawless.
Far from it.
There is a serious execution overhang, specifically regarding the robotaxis. The original goal was to have autonomous robotaxis operating in 50% of the U.S. by the end of 2025. But that timeline has been severely downgraded. Now, management is aiming to cover just 12 states by the end of 2026.
Yeah, that's a huge slip.
And on top of that, there is ongoing legal noise. The sources mention a federal judge recently rejected an immediate $1.5 million SEC settlement for the CEO.
Honestly, the legal noise is just a sideshow.
You think so?
Oh, yeah. A $1.5 million settlement delay for a company holding $35.5 billion in cash is essentially a rounding error. Institutional investors ignore that completely. However, the execution risk on the robotaxi rollout, that is the true Achilles heel of this entire valuation model.
Right, because if they are trading at 15 times sales based on a software narrative, and that robotaxi timeline has already slipped from half the country to just a dozen states, aren't they incredibly vulnerable to a massive multiple compression if they miss this next deadline?
They absolutely are.
And just to define that for the listener, multiple compression is this violent market correction where investors suddenly decide your company isn't the magical tech unicorn they thought it was.
A bubble pops.
Right. They slash the premium they're willing to pay, causing the stock price to plummet even if your underlying business is still generating the exact same amount of money.
They are deeply vulnerable to a compression event. When you are priced for absolute perfection, any delay in the autonomous timeline is punished brutally by the market. If December 2026 arrives and they are only operating robotaxis in 3 states instead of 12, Wall Street will aggressively strip away that 15x multiple.
The stock would tank.
But, and this is the vital counterweight to that bear case, the mitigation to that timeline risk brings us right back to the fortress balance sheet.
The $35 billion.
Exactly. They have $35.5 billion in cash to weather the delays, to fund the ongoing compute research, and to sustain the company until the AI algorithms actually achieve autonomy. They aren't going to go bankrupt waiting for the software to learn.
Synthesizing all the research we've unpacked today, we are really looking at a tug of war between the risks of a compressed valuation and the massive safety net of their cash reserves.
That's the core tension, yeah.
The primary source material provides a bullish score of 8 out of 10 for a multi-year hold, specifically targeting a 12 to 24-month horizon. What's the thinking there?
The logic behind that 12 to 24-month horizon is that it allows the investor to capture the actual commercialization cycles of these new technologies.
Seeing the rubber hit the road, literally.
Exactly. Over the next 2 years, the market will finally see if the robotaxi fleet validates, if the Tesla Semi can aggressively scale and disrupt diesel logistics like we talked about, and if the Terafab foundry successfully secures that internal chip supply.
And for you listening, as you track this narrative, there are two massive upcoming catalysts to mark on your calendar. First, early July 2026. That is when the Q2 delivery numbers will hit the tape.
That's going to be a big one.
Huge. The market will be watching like a hawk to see if that massive April rebound we discussed in China and Europe translates into a blowout second quarter, proving the auto division is structurally sound. Second, and perhaps more importantly, the mid-2026 Optimus humanoid robot unveiling event.
The Optimus program is the absolute wild card here.
It sounds like sci-fi.
It does, but they are pushing incredibly hard to demonstrate early commercial deployments of these humanoid robots in their own factories. If they can prove that generalized automated labor is a viable, scalable product, the total addressable market expands from global transportation into literally every sector of the physical economy.
It really is a fascinating pivot. We started this deep dive looking at the old debate of whether they were a car company or a tech company. And the Q1 financials clearly point to a software and energy future.
Without a doubt.
But I want to leave you, the listener, with a slightly different paradigm to ponder based on the research we've discussed today. If this company successfully secures its own semiconductor foundry, commands a global grid-level energy network, and actually deploys a fleet of AI-driven humanoid robots into the industrial workforce over the next few years, at what point do we stop comparing their valuation metrics to legacy metal benders like Ford and Toyota and start comparing them strictly to infrastructure giants like NVIDIA and Apple?
It really is the defining financial question for this company over the next decade.
And it's something we'll be watching closely as those July delivery numbers approach. Thanks for joining us for this deep dive into the numbers behind the narrative.